Hello and welcome. Today we're diving into one of the most important regulatory updates in India's digital payments ecosystem, the Master Direction on Regulation of Payment Aggregators issued by the Reserve Bank of India on September 15, 2025. This new framework impacts banks, fintech companies, payment gateways, merchants, and global entities facilitating cross-border transactions. In this video, we'll break down the purpose, definitions, authorization requirements, governance norms, KYC obligations, escrow account rules, and more in a simple, structured, and easy to understand format. India's payment ecosystem has grown rapidly with millions of online and offline transactions happening every single day. The RBI earlier issued guidelines on payment aggregators and payment gateways in 2020 and 2021, and later directions for cross-border PAs in 2023. With feedback from the public and industry stakeholders, the RBI has now consolidated all rules into a single comprehensive master direction. This framework has been issued under the Payment and Settlement Systems Act 2007 and the Foreign Exchange Management Act 1999. Its goals are strengthening customer protection, ensuring secure, regulated payment flows, enhancing compliance by online and offline PAs, bringing clarity for cross-border PA businesses. These directions apply to all bank and non-bank entities operating as payment aggregators. They also apply to authorized dealer banks and scheduled commercial banks that interact with or provide support to PAs. What's important here is the broad applicability, not just to online aggregators, but also PAP, physical point of sale aggregators, PAO, online payment aggregators, PACB, cross-border aggregators, facilitating inward or outward payments. The new definitions clearly distinguish each category and outline their permitted activities. To help standardize the industry, RBI has defined important terms. Some of these include payment aggregator, PA, an entity that collects payments from customers on behalf of merchants and settles them. PA-P, physical transactions where the payment instrument and acceptance device are in close proximity. PA-O, online transactions where both are remote. PACB, cross-border P as handling import/export related payments. Merchant, any seller of goods, services, or investment products, including exporters. Escrow accounts, special bank accounts, where PA funds must be held before settlement. These clear definitions remove ambiguity and support uniform compliance across platforms. One of the most crucial elements of this direction is authorization by the RBI. Here's what it mandates. Banks do not require separate authorization. Non-bank payment aggregators must apply for RBI authorization through the online portal. Must have a minimum net worth of 15 crore rupees when applying. Must increase net worth to 25 crore rupees within 3 years of authorization. Must be a company registered under the Companies Act 2013. Foreign direct investment rules also apply where relevant. These measures ensure only financially stable and compliant entities operate in the payment space. Strong governance is mandatory under this framework. Boards, promoters, directors all must meet the fit and proper criteria related to integrity and financial soundness. RBI also requires PAs to implement a robust dispute resolution system, proper refund handling, fraud detection and cybersecurity systems, regular system and security audits, compliance with PCI-DSS, PCI-SSF, and storage of payment data within India. This ensures safer transactions, especially at a time when digital fraud is on the rise. The direction outlines very clear due diligence responsibilities for PAs. Each PA must conduct full KYC of every merchant, including obtaining and verifying PAN checking, CKYC records, contact point verification, background and antecedent checks. Special rules apply for small merchants with lower turnover, allowing simplified onboarding. Acquiring banks must ensure merchants onboarded through PAs adhere to these guidelines. This improves traceability and reduces risk of fraudulent merchant activity. Perhaps the most operationally important section concerns escrow accounts. The RBI mandates that all non-bank PAs maintain merchant funds exclusively in escrow accounts with scheduled commercial banks. These accounts must keep domestic and cross-border transactions separate. Follow strict permitted credits and debits. Allow no interest except on a computed core portion. Be used only for PA activities. There are dedicated rules for inward collection accounts, INCA, and outward collection accounts, OCA, for cross-border PAs. This framework ensures transparency, prevents misuse of funds, and protects merchants. Authorized PAs must submit regular reports to RBI, including quarterly escrow account certifications, annual net worth certificates, monthly transaction statistics, cybersecurity, and system audit reports. This strengthens supervisory oversight and ensures high compliance across the ecosystem. In conclusion, the RBI's master direction on payment aggregators marks a major step forward in regulating India's fast-evolving digital payments ecosystem. By bringing together rules for online, physical, and cross-border PAs into one unified framework, the RBI aims to ensure transparency, safety, and financial stability. Thank you for watching. If you found this breakdown helpful, don't forget to like and subscribe for more regulatory explainers and fintech insights. Moonses and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence, a pioneer in establishing SEZ and IFSC units within GIFT City and India, delivering end-to-end IFSC setup, operational support, and handling compliances, risk management, renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university, BATF, and ancillary regulations, and fintech expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA, comprehensive support, covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards.